All right, time to get started. First lesson is for me, don't make a take-home due just before class if I'm going to let people submit it over the internet. Making a take-home due at the start of class, if people have to bring it in, is fine. It actually encourages people to show up and get their stuff done because they're running in breathless trying to put it on the file before the class starts. And as near as I can see, there are now 40 people who ought to be here who aren't here, who are busily sitting at their computers emailing me PDFs right now. Maybe they're just outside with laptops furiously trying to connect to airbears and cursing as congestion increases and will show up quickly. Maybe they're at home and are exhausted and are about to collapse and not show up. Whatever, I'll do better next time. Today I want to do the third of our government budget lectures, which turns largely into the second healthcare financing lecture. But first, logistics. Problem set 9, which is also a sample final exam, will be out tomorrow on the internet. And this week's readings are Marty only in my textbooks, chapters on long-run fiscal dilemmas on the one hand, and on stabilization policy on the other. And as I said, the take-home assignment is due now via email. We have 4 more classes left, including this one. I think this class I'll hopefully finish the government budget stuff. Next week, I think, should be devoted to doing problems and to final review. And that leaves me with one class on Thursday, which may be taken up with government budget, and which may be taken up with a review of the current state of the world economy, depending on how far I get. And looking forward to the exam and to problem set 9, I'm going to try to cover all 22 of these things on the final exam in one way or another. The kind of give an edge to people who know something about a lot of things, rather than a lot about a few things. And you'll see more of that when the sample final / problem set 9 comes out tomorrow. So on to America's budgetary dilemmas, and on more particularly, what I've been spending the last 29 hours doing. That is, Standard & Poor's, one of the world's major rating agencies, came out with an announcement early yesterday morning that it was thinking of possibly in a couple of years downgrading its rating of the debt of the United States of America. The debt of the United States of America is now rated AAA, AAA. They said they were thinking of possibly in 2 years downgrading that debt to AA. And as soon as they announced this, market prices jumped. Or rather, market prices in 2 of the 3 major financial markets jumped. Where'd it go? On the stock market, prices actually started falling a little bit before the announcement. But stock prices fell far and fast before and in the half hour after the announcement by about 1.5%, a little more. The value of all of the companies in America, their value to their owners, their shareholders, was 1.5% less after the Standard & Poor's Statistics Company made this announcement than it had been before. That's perhaps $150 billion of wealth destroyed by one short press release by a ratings agency. That is, people dumped stocks, and the people selling couldn't find buyers until prices had fallen by 1.5%. And then afterwards, prices began rising again gradually after the middle of the day as a couple of other pieces of news came in. But there's no systematic trend for recovery. In the bond market, the interest rate on the 10-year U.S. Treasury bond, people didn't know what to do. First, the interest rate dropped, then it spiked up. Then, over the next 3 hours, a bunch of people said, hey, wait a minute, U.S. Treasury bonds are now really cheap. Then a bunch of smart people said there's a market opportunity here and came in. And by lunchtime, it was back to where it had started, the interest rate on U.S. Treasury bonds. And in the afternoon, other things happened that tended to push the interest rate on U.S. Treasury bonds down. So that even though there had been a sharp and apparently permanent fall in stock prices when this piece of news hit the economy and the financial markets, there was an initial move, but it was then rapidly reversed after an hour or two after people had time to think about it. And the third major financial market, the foreign exchange market, the value of the euro in dollars, well, the dollar strengthened a little bit on the announcement. The dollar certainly didn't weaken on the announcement. After the announcement, you could buy a euro with fewer dollars than before. And then as people thought about it, the dollar began to strengthen even more. So that by its dollar's high on Monday afternoon, the dollar was worth something like 1.5% more in terms of euros than it had been worth at the start of the day. 3 big movements, 3 price reactions that are clearly reactions to one particular amount by the Standard & Poor rating agency. And James Fallows of the Atlantic Monthly, not a professional economist, but one of the shrewdest observers of the economy that we've seen, a longtime journalist, someone who I wish would come back to Berkeley and agree to be during Dean of our journalism school someday, former speechwriter for President Carter, et cetera, et cetera. James Fallows of the Atlantic Monthly is greatly puzzled at this. He knows, he says, that markets run on fear, greed, instinct, and panic as much as logic, but seriously, how could this non-story have dominated the news today? And he repeats 2 points that make him think that nobody should have noticed this. The first is that the Standard & Poor's rating agency knows absolutely nothing about America's politics and budget than you or I do. And they're saying they have an opinion on the state of congressional White House dealings on the budget, and that opinion makes them more pessimistic than they have been in the past. And James Fallows' response is fine. Go on a talk show. Go start a blog. And second, what a AAA rating is supposed to mean. The Standard & Poor's Corporation says that it's not an investment advisor. It doesn't tell you whether you should buy or sell securities. If it were an investment advisor, the Securities and Exchange Commission would be regulating it much more closely than it does. All that the S&P Corporation does, it says, is construct indexes and also give opinions on the likelihood of future events. And in this case, the likelihood of the future event is the chance that you'll take your bond to the U.S. Treasury when it matures, and the U.S. Treasury will say, sorry, you can't have your money. You have to sue us if you want to. That a bond is rated AAA when the chance of its defaulting is very, very low. And when S&P says it's thinking about possibly in the future lowering the rating of U.S. Treasury bonds from AAA to AA, what it's saying is that it's thinking that U.S. Treasury bonds are changing from a security where default is almost absolutely unthinkable to one in which default is not quite unthinkable. And as J.D. Galbraith said yesterday, that kind of makes no sense because the U.S. government is not going to default on its bonds no matter what. When you show up, the U.S. Treasury will give you money. It may have printed the money. It may have printed so much money that there's a bunch of inflation. But there won't be a default event. And so the thing that the AAA rating is supposed to convey, whatever the S&P thinks its ratings are conveying, it's not the likelihood of a default event, which is what they are supposed to be. And those seem good points. So why then was the S&P's opinion about something where it has no special knowledge of such great interest to the stock market, without being of any interest to the foreign exchange market at all, and being of some slight but very temporary, quickly unwound by 11 a.m. Eastern time interest in the bond market? And that's what I've been spending the last 29 hours working on and talking about, and it's relevant here because it's an important part of the discussion of the government budget. What did the S&P actually do? Well, Nicholas Swan of Standard & Poor's, one of their analysts, sent out a press release in which he said, "We believe there is at least a 1 in 3 likelihood that we could lower our long-term rating on the U.S. within 2 years. The outlook reflects our view of the increased risk that the political negotiations over when and how to address both the medium and long-term fiscal challenges will persist until at least after national elections in 2012. The first thing is that this is hard to parse. That is, at least a 1 in 3 likelihood means that there's a 1 in 3 chance or greater of something happening. What is the something that's happening? Well, that the S&P could lower its long-term rating. Not that it will lower its long-term rating, not by how much it will lower its long-term rating, but there's a 1/3 chance that something becomes a possibility. And how will you ever evaluate that? If the possibility doesn't then come true, what was the 1/3 chance of? But nevertheless, this announcement did trigger the sharp drop in U.S. stock market values in U.S. equities. And the conventional interpretation of when this happened is that it was going to be new news, that the market was taking S&P's reading of the political situation as news about the future of American governance, of the news about future taxing, spending, debt, and deficit. But there also is old news. Maybe S&P was announcing something, but it wasn't really news, that the smart money had already incorporated it into financial prices. Maybe it was not news at all. Maybe S&P is completely irrelevant. Or maybe it's a remark, a decision, an announcement that had an effect, not because Standard & Poor's has information about finance that other people don't, but because Standard & Poor's is making a move in a political game. And so let's start with new news. Suppose that this S&P announcement were genuinely new news, like when a normal stock analyst looks at Apple Computer, calls up 83 Apple stores around the country, surveys 15 customers of Apple, goes over to China and talks to a bunch of suppliers, talks to a bunch of industry gurus, and comes out with an opinion of the likely size of Apple's market and the likely profit margin it's going to be able to maintain. It's genuinely new news, and people read this, and they buy or sell Apple stock upon reading it, and the stock price goes up or down. That's one thing that an announcement can be. What would have happened if this announcement were bad news about the likely future of U.S. government? If this were news that the budget deficit is likely to be larger and the debt is likely to be higher in the future than we had previously thought? Well, if that were the case, then with a higher budget deficit, a larger debt, a bigger gap between spending and taxes, we'd have to say that the chances that at some point in the next 10, 20, 30, or 50 years, the U.S. government is going to throw in the towel and say that the best way to deal with our outstanding national debt is to pay it off by printing a bunch of money. That if we raise the price level by expanding the money stock, then the debt, which is denominated in dollars, will be less burdensome on the economy, and so we can deal with the debt by inflating it or inflating a piece of it away. So then you'd say that S&P is raising the chances, or raising its expectation of the chances of that inflationary outcome. And if you think that there's the likelihood of inflation in the United States is going to be higher, what should happen to asset prices? Well, 2 big things should happen to asset prices. First, bond interest rates on U.S. Treasury should spike up and should stay up. Why should they spike up and stay up? Because with higher inflation, if you commit loan your money to the United States and agree to let the United States pay it back in 10 years in dollars, the value of which it defines, those dollars are going to be worth less in 10 years, and so you're going to require more interest on the bonds that you buy in order to compensate for the fact that inflation will be eroding away the real value of your principal much faster. So that whenever there's bad news about a government's finances, which raises the likelihood of inflation, you see its interest rates jump up and stay up. You see this God knows how many times in Brazil, Argentina, Mexico over the past century. We don't see that here. We see the jump, but the jump is relatively rapidly reversed. The second thing you see, if you see a piece of bad fiscal news that raises the likelihood of future inflation, is that the value of the currency falls. That after all, a country that's undergoing inflation will have its currency worth less in terms of other currencies in the future. And that means that if you're an investor in that currency now, you'll want to sell so as to get as much as possible out of it before its value depreciates. And the fact that you're selling now means its value depreciates somewhat now. So we ought to have seen the euro spike against the dollar yesterday morning. We didn't. We saw no sign. As to the stock market, well, if this is news that the budget deficit's going to be bigger, the debt's going to be higher, the likelihood of inflation's gone up, it really can push the stock market either way. On the one hand, macroeconomic chaos means it's hard to earn profits, and so these companies whose stocks are in the S&P stock index won't be paying as much in the way of dividends in the future. On the other hand, in an inflationary environment, stocks are a pretty good asset because they aren't fixed, their value isn't fixed in terms of nominal dollars. That if the price level doubles and wages double, well, product prices have doubled as well, and profits have doubled in nominal terms. A fear of inflation both makes people worried that macroeconomic chaos will make it difficult to conduct business, but also makes people think that real assets, that actually companies that know how to make things, are a better place to put your money or a better place to invest in than are simply nominal assets whose value is guaranteed to go down as inflation comes up. And so it's not clear which way the stock index should go. It might go up, it might go down. There are offsetting effects. And these offsetting effects, you'd presume they close to balance each other out. So we thought we would see, or at least if you'd asked me on Sunday night what would happen if the S&P downgraded the U.S. and that carried information about the likelihood of future of deficit reduction deals, was we'd see Treasury interest rates spike and stay up. We'd see the value of the euro in terms of dollars spike up and stay up. The stock market probably wouldn't go much of any place. But if it did go, it wouldn't move nearly as far as the other two markets. And yet it's the stock market that went down, and the other markets that didn't move or didn't move persistently. So it's not new news. Is it old news? Is it stuff that people already knew? And thus it didn't move prices because everyone said, yeah, we already knew this. They should have announced this a month ago. There's no information in there. Well, it's hard to argue that it's no news because the stock market moved by so much. Something definitely happened, and something happened early Monday morning. It's not that people suddenly became much more alarmed about the European situation because nothing happens early Monday morning in New York and Europe. The European news of the day has already come in. So it's not old news. And it's also not that people think that Standard & Poor's is irrelevant to the market. because once again, stock prices moved a whole bunch. And what does that leave us with? That leaves us with the political explanation. That we should view this particular announcement not as Standard & Poor's bringing information about what the government's doing to the market, and the market then incorporates that information and people buy or sell stocks, bonds, and currencies in reaction to it. But instead, Standard & Poor's is making a political intervention in the U.S. political process. And people are saying, aha, because the S&P Corporation is making this intervention, well, the world is now somewhat different, and so we have to calculate what the likely futures are, and the probabilities of likely futures have changed. And what would that announcement have been? What kind of political news about the deficit could have been produced by the S&P announcement that would have sent stock prices down while leaving Treasury bond prices and currencies more or less unchanged? Well, there are, say, three possibilities. The first possibility is that the people investing in stocks said, aha, Standard & Poor is putting pressure on the Congress to fix the budget deficit by saying it's a problem and we may downgrade your debt if you don't solve it over the next 2 years. They're trying to get Congress to take action, kind of like hitting a mule with a stick. What will Congress do if it decides it has to reduce the deficit? Well, cutting spending on programs that middle Americans like is very difficult and unpopular. Raising taxes is difficult and unpopular, especially taxes on individuals. Maybe people will go back to 1986 and to the Bradley-Reagan tax reform, where they finessed this issue by saying we're going to cut marginal income tax rates on individuals, and we're going to broaden the tax base, and we're going to raise a little revenue by taxing corporations, not people. We're not raising anybody's taxes, we're just raising corporations' taxes. And of course, there's something very wrong with that. While a corporation isn't a person, a corporation is made up of people. And if you tax the corporation, then someone, whether it's the suppliers, the workers, the managers, the bondholders, or the stockholders, aren't going to get those flows of money out of the corporation that they had been expecting, that they had been anticipating. But the fact that they were taxing a corporation and not individuals made it easier to get congressional majorities for the 1986 tax reform. And so we wound up for a while with higher corporate taxes. Maybe the market is reacting to this by saying, if Congress acts, it's going to act by taxing corporations. And the people who bear most of the impact of an increase on taxes on corporations will be the shareholders of companies that make profits and pay dividends. So they may be thinking this is probably good news for the country, but it's certainly bad news for us, because an increase in the likelihood that we'll be taxed in the future makes our property worthless. That's one possibility. The second possibility is that they'll say, well, gee, if Congress makes a deal, and given its unwillingness to increase taxes, and given the political poison involved in decreasing long-run spending, especially long-run spending on the middle class, they will make progress by cutting back on short-term spending in the budget, especially short-term spending aimed at the poor. And that immediate reduction in government purchases, would put downward pressure on the economy, would slow the recovery, might produce a renewed recession, and that would have a negative effect on business profits and thus stock dividends in the short term. So maybe they say this is news. It may or may not be good news for the country, depending on how the spending cuts are implemented, but the spending cuts likely mean renewed recession in the short term, or at least a greater chance of it, and so a lower profits for us as shareholders. Or the third, it might have been something else. Right? Maybe that there was other pieces of news moving through the stock market early yesterday morning that we don't know about because it didn't make the headlines. A bunch of whispered conversations among a bunch of people about things that the press didn't really cover. If so, we'll find out in the next week or two. And of course, there's always the danger in over-interpreting short-term market movements. Lots of times, stock markets, bond markets, currency markets go up or down, and afterwards you're left scratching your head and saying, why did it do that? And often you never come up with an answer. That is, the best answer is that people changed their mind. And why did they change their mind? Well, X changed his mind because Y changed her mind. Why did Y change her mind? Because Z changed her mind. Why did Z change her mind? Because W changed his mind. And there's no rationality to it in any deep sense. It's just that people are reacting to what they learn about each other's beliefs by changing their own beliefs and changing their minds. And this simply introduces noise into the system. And who was it? Some economist once said that in this conference that the most important thing is that markets vary more when they're open than they're closed, which caused a great laugh. But the general import of that is that if you turn off markets, like they turned off the foreign currency market in New York between late Friday and early Monday, and there are no transactions, well, then you know that at the end of the period you expect prices, unless there's been a lot of public news about where they were at the beginning. But if the market had been open during that day, then prices would have either gone up or down, and odds are that increase or decrease would then have been incorporated into its post-Monday reopening path, and the price would be different today. That is, don't overinterpret short-term market movements, because even though these are markets where it's hard to make a lot of money easily by betting against them, nevertheless, the amount of deep rationalities in market movements is relatively limited. That's what I've been doing for the past 29 and a half hours now. And the fact that an S&P announcement, even this little announcement, there's a 1 in 3 likelihood we could lower our long-term rating on the U.S. within 2 years. The fact that this announcement by one particular rating agency can wipe $150 billion off of the collective wealth of America is an indication of how vulnerable and worried people are at some level about the long-term U.S. fiscal situation, about our ability to match our taxes to our spending level and keep them there over the next generation or a generation and a half. That is, if the government budget and if the long-term finances of America were not worth worrying about, that decline simply wouldn't have happened. People would have said, who cares? And why do they care? Well, they care, as I said before, because nobody really believes in the current law baseline. That nobody currently believes that the Affordable Care Act's restrictions on Medicare growth and the Affordable Care Act's high tax on high-cost health plans will be allowed to go into operation and extended without limit. And nobody believes that the alternative minimum tax will be allowed to affect more and more Americans as time passes. Instead, people believe that Congress is going to take some actions over the next 25 years. And those actions will tend to reduce revenues and increase spending and will leave us with a large long-run deficit problem. Which does raise the question that if Congress is really worried about